Hi everyone, in this video we're going to focus on the accounting for investments in associates and joint ventures. These terms were introduced in the previous video where we discussed different levels of dependence, connection, relationships between investor and investee in what we call intercorporate investments. Now, in the case of associates and joint ventures, both of them, we're going to be applying the so-called equity method. So this video is going to be very much about the equity method. However, there are more details on the equity method beyond this video, and that's coming up obviously in subsequent clips as well. So let's just draw the little axis that I had before. You may remember that when we labeled this as the percentage of ownership, there was an important point, namely 20%, where it is deemed that if you it's assumed that if you cross the 20% threshold in terms of the proportion of shares that you own in another business, or the voting shares that is, but do not exceed 50%, where if you exceed 50% you would go into control territory, and that's consolidation. Over here it is assumed, or we assume, significant influence. The accounting rules assume that you exercise or exert something called significant influence, and obviously below 20% we assume that such influence does not exist. We assume no significant influence, and it's that significant influence, its existence or not, that gives rise to the equity method being used, or indeed not. So this is significant influence, but not control, very importantly. Okay, and I think, as I mentioned in the previous video, these guidelines, though, the 20% or 50% threshold, they're just supposed to be rough guidelines. It is absolutely possible, and often happens, that you prove that somebody does have significant influence even though they don't have the 20% or more. And sometimes companies exert control, exercise control over one another, even though they haven't crossed the 50% threshold as well. Now, you need to know a little bit more about what significant influence is. I mean, beyond owning a certain percentage of the shares, which is sort of rule of thumb, it may also be, or it is evidenced by, what are some of the sort of real life evidence of there being significant influence? Well, as an important shareholder, maybe you've got representation on the board of directors, so you've got a seat at the table. Maybe, and that gives you the significant influence over various important strategic matters of the company. Maybe you participate, I guess that's linked to the point above, but there's some participation in the policy making process. We're not talking about day-to-day decisions. We're talking about the really important strategic financial types of, I guess, decisions that affect the company's performance. Maybe, significant influence comes from there being material transactions between the investor, that's the owner of the shares, and obviously the investee, that's the company in which the investment is made. Material transactions alone, or the significance of transactions, their volume, etc., is absolutely very important. Maybe, there is some interchange of personnel, especially at management level, right? Interchange of management personnel, that could also be evidence of there being significant influence. And maybe that other company is technology dependent on us, so technological dependence is another possible trait, right, characteristic. Good. Anyway, at the end of the day, this significant influence, what it effectively equates to, what it means is that the financial and operating performance of that other business, of the investee, that associate, is at least, is partly influenced by us, by the investor, right? Not completely, it's not control, it's just partial at least. Now, as we mentioned before, when you've got yourself a company over which you exercise significant influence, we call that an associate. And for associates, the relevant accounting method is the equity method, which we will be exploring in just a moment, at least start exploring it. There is more to come in subsequent videos. And that equity method is also applicable to jointly controlled entities, so companies that are under common joint control, which we often associate with the term joint ventures. Now, this is not going to be a big topic, but you have to know a little bit about it. Jointly controlled means there are two or more investors, venturers, and there's a contractual agreement between them to jointly control that business. Now, in reality, this often plays out in a way where each of the investors has 50% of the shares and therefore half of the votes. However, it doesn't have to be 50% each. It actually doesn't have to be two investors. It could be more than two. It could be three. What is important, and this is the condition for joint control to actually technically exist, is that all important decisions require the unanimous vote of all those, or all the joint controlling parties. So even if it's three parties that jointly control a business, it can't be the case that two of them form a coalition and vote against the other one, the third one. That's not joint control, even if they've got an even split of the shares. Joint control means that in the case of three partners or three, investors, all three need to agree for certain decisions to be taken, and it's not about majority versus minority. It has to be unanimous. Typically, you'll have a 50-50 sort of percent split, and that's how most joint ventures are formed. I mean, that's the easiest one to imagine. Okay, your book also says that these joint ventures or jointly controlled entities, at least in rare circumstances, may be accounted for using what we call proportionate consolidation. Proportionate consolidation. And you don't need to perform this. You just need to know what the outcome would be in contrast. So this is permitted in rare circumstances, but your book, I guess, wants you to appreciate what the difference would be versus the equity method, which is a sort of default method to use here. So what I want to do is I want to tell you how the equity method works by means of a very simple example, and that example is as follows. We are an investor who acquires, so an investor acquires, let's say, 25% of the share capital of another business. We'll call that business the investee. Okay, and the price paid for this is 10 million euros. Now, in reality, you need to be a little bit more specific about what it is that you're buying, kind of what are the assets and liabilities and their value of in the investee, etc. We're not going to do that. We're going to keep it simple. And anyway, we're following the logic that's also in your book. They first do a simple example and then they kind of go, it's actually a bit more complicated, but that will happen in the next video. Now, that's the moment of purchase, but also in the sort of year, think about a financial year following that investment, the investee, so that company that we now have 25% of, at least in terms of the share capital, the investee generates, let's assume, 6 million of net profit, net earnings, okay, and actually the decision is taken to pay from that, 6 million, use 4 million of that, so that's 2/3 to pay out a dividend. Pays 4 million in dividends, a dividend ratio of 2/3, 66.6%. Right. Now, how do you account for this? Let's take a fresh template, financial statements template here, on which I'm going to say that this is the equity method that we're using here, and hopefully this will be better than the description in the book, because in the book they just do a table. I want to show you how the whole thing sort of works across the different segments and different blocks of the balance sheet and the income statement. Right, so starting with that initial investment. The investment, remember we paid 10 million, is initially recorded or recognized at cost. And it's going to be recognized in a single line within non-current assets, right? A single separate line within or under non-current assets. So let's just check back here. Yes, we did, well, I assumed we paid 10 million. So let's do that. Let's record the investment. I'm assuming cash flows out. That's not necessarily always the case, but 10 million flows out, and it gets sort of exchanged for a non-current asset. Let's call it investment in associate, because I'm assuming, that holding 25% of somebody's shares does give me significant influence. Actually, I should have probably started with that. If we hold 25% of somebody's equity instruments, well, I'm assuming that gives me significant influence, and therefore that company is my associate. So it gets initially recorded at cost. Good. And now for the next step, sort of what happens subsequently? Well, subsequently, we're told in the year following the investment, that investee generates 6 million in net profit. Okay. If this was just a simple financial asset, not one where I've got significant influence, the information that it generated a profit or any kind of result, profit or loss, wouldn't really do much in terms of my accounting, because I would wait for its decision to pay out a dividend. And if there was a dividend, I would record dividend income in my cash going up and my P&L going up as well, recording the element of income and the financial income, dividend income. But because this is not just a simple, financial asset, it is an associate. I'm going to use a different approach. I'm going to, first of all, measure my share of that associate's gain. So I'm going to actually recognize the proportionate share of the investees' gains or losses. In my case, it's gains. Well, we assume that they generated a gain of 6 million. Good. 6 million. My proportionate share is obviously 20%, 25% of that, which is going to be 1.5 million. And that will go to two places at once, to my P&L and my assets. Okay, so within the income statement, you will have a dedicated line, which may be called, different things depending on how the company wants to call it, but you could call it something like share of net profit of the associate, or share of investees' net profit. I'm going to say associates' net profit. Remember that this could also be applied to a joint venture, so it's not just associates. But whenever you use the equity accounting method, equity method of accounting for associates or joint ventures, you're going to have a dedicated single line within assets, and also a corresponding sort of dedicated line within P&L as well. And it typically comes just before sort of profit before tax, towards the bottom of the P&L sort of construction. Now here I'm going to record that 25%, so my share of its income, 6, which is plus 1.5, and that enters my P&L in a positive way. And it's not because I've received a cash dividend from that company. No, there's been no inflow of cash. This is just my share of their profits attributable to me, sort of. And I impact the P&L with this amount, right? The P&L, but also assets. So within assets, I increase by this 1.5 the investment in the associate kind of grows. And then the third step is dealing with the dividend, because we said, let's assume it pays 4 million in dividends. Okay, so that's number 3. Dividends are received. And we get 25% of the dividend income, which was, the overall sort of, it's not income, the dividend payment was 4 million. So it's going to be 25% of 4 million, which is of course 1 million. And this obviously comes in as cash, 1, but no need to have that arrow over here. We've got one above. It reduces the investment value. Your book describes this as the dividend being treated as a return of capital, as if somebody was paying down capital that was invested into them. So that one growth of cash corresponds to a drop in the value of the asset, as if a receivable was being repaid. But at the end of the day, what you've got is an investment in the associate of 10.5 million. Now, let me just emphasize that if this was not an associate, if you were treating this as just a simple asset, something that you don't have significant influence over, less than 20%, or even you've got 25%, but you don't think you've got significant influence, you would wait until this dividend and go with that dividend to the P&L, just the 1, right? Here, when you receive the dividend, you don't go to the P&L and you don't record plus 1 within P&L, because you've recorded already the entire, the share of the profit from which that dividend is later paid. And you can't record both the share of profit as something positive, or your proportionate share of the profit plus the receipt of the dividend, because you'd be sort of double counting the same profit twice in your P&L. Now, please appreciate what this 10.5 actually is. It's composed of, you can sort of decompose it to the original purchase price which was of course 10 million. And on, that additional 0.5 is our share in the net change in the associate's equity following our investment. So that associate generated 6 million in gains, and then obviously the gain causing growth to its equity. And then when the dividend was announced and paid, equity dropped by the amount of dividend. Well, the dividend paid was 4 million. So the net increase, the net change in equity was 2 million, in which we have a 25% sort of proportionate share, giving us a 0.5 claim to that growth in equity. That's the essence of the equity method. You account for the purchase price plus or minus your share in the net change in the associate's sort of equity, following obviously the making of that investment by you, the investor. If the associate had not paid a dividend, we would have stopped here. 10 million purchase price plus growth in equity at the associate of 6, because they generated a profit of 6, income of 6. But no dividend was paid, so there was no reduction to equity. If there was a dividend paid, but it was 100% of the profit, so a 100% dividend payout ratio, we would have had an increase of 1.5, but the dividend would have been 1.5 as well, reducing us back to the initial 10 million. That's kind of the way to understand it, I think, the best way to understand it. Okay, let's just go back for a moment to the note and say that in the case of losses, obviously losses at the associate producing losses, the investment as sitting in our balance sheet, the carrying amount of it, instead of increasing, would be dropping, because we would be changing it by our share of the associate's net result. And what typically happens is, if the drops continue as a result of the associate or joint venture producing loss after loss, if it drops all the way down to 0, what typically happens is companies stop using the equity method. So at this point, the equity method or accounting using that method is discontinued. Otherwise, you would have to, well, you wouldn't record a negative asset, you'd have to change sides into liabilities, but that's only if you have an obligation to really in some way cover the losses of the associate beyond the value of your investment, which is possible but rarely the case. Now, I did mention somewhere up here, and your book mentions it, that it is in rare circumstances, right, possible to use proportionate consolidation. And then, for some reason, your book expects to appreciate what would happen and how this would contrast with the equity method that I just showed you. So let's think about the P&L. Under the equity method, within P&L, you've got a single line where we show our share of the net gains or losses, of course, of the investee, that investee being the associate or the joint venture. And obviously, those net gains or losses are themselves, apologies for that. Those net gains or losses are themselves the result of taking income and deducting expenses. So we don't show our share of the individual revenue, income items and relevant expense, all the expense items, multiplied by 25%, but we just show in a single line our, let's say, 25% share of the net result, which is a function of those individual income or loss items. However, if you were using the proportionate method, which is not possible to use for associates, but it is possible in rare circumstances to be used for joint ventures, you would actually take line by line your share of revenue, income, expenses, all the items line by line of each P&L line. But of course, as I said, over here we're kind of implicitly doing that as well. We're taking our share of all the income and expenses, we're just putting it into a single line at the bottom of the P&L instead of distributing it across the P&L, vertically. After all, at the end of the day, so to speak, the impact on total income is going to be the same. It's just how we present it. So we're also going to have very different ratios being computed because you don't have items from the associate or the joint venture. Under the equity method, you don't have any impact on revenue and different costs. You just have impact on the overall profit or loss. But with proportionate consolidation, every line potentially is impacted, but different ratios. And a similar argument may be also made for the balance sheet, where under the proportionate method you would take your share, for example 50% in a sort of classic to investor, to venturer, joint venture, or your share of all the assets and liabilities of that joint venture. Here we take a net amount and include it in one line, the amount, starting with the amount we paid. In theory, using simplifications, it's going to be the same net impact, but completely differently spread out.